In this video, I'm going to give you the top 5 worst investing mistakes by beginners. As with anything in life, we have to crawl before we can walk. We are not professionals anytime we start something for the first time. And hopefully this video can help you, first-time investors, avoid these pitfalls. Hi, my name is Adrian and this is my channel, Always Talk Money. I like to talk money as it relates to everyday life, help you on your financial journey. With that being said, let's get into the video. The first investing mistake that is made by beginners is not starting early enough. For compound interest to work in your favor, it needs time. You need that time to get that exponential growth. But so many people, because they're beginners, because they don't understand fully how investing works, they procrastinate and they don't get into the game early enough. And by the time they figure it out, by the time they understand it, they have lost hundreds of thousands of dollars in terms of compound interest investing in their favor. Listen, a lot of people get a job and they don't even sign up for the free company sponsored 401k plan. They just kind of see it as a job. They just go to work, but they don't think of it in a long-term type of way. Even if you're not going to stay at that job very long, you need to make sure you are taking advantage of those benefits, because those benefits can transfer. If you know how compound interest works, you know that 1 year, 2 years, 3 years, 5 years worth of compound interest makes a huge difference. There's a YouTube channel called The Money Guy Show, and they have this recurring bit that they do where they show that $1 invested at 20 years old versus $1 invested at 30 years old is $100 difference. And that's 10 years, and that's $1. So imagine thousands and thousands and thousands of dollars that you could have invested at 20, at 30, at 40, but you started at 45 or 50. You could be leaving $1 million or more on the table. So do not make that investing mistake by not starting early enough. The second investing mistake made by beginners is they try to time the market. This is a no-no. Do not do this. Do not listen to day traders and forex people and all these gurus and candlestick merchants. There are people that can do this stuff. There are people that make a lot of money doing this stuff. But if you are not really passionate about day trading and investing on that level, then I wouldn't jump into it, because I'm someone who loves investing and is interested in personal finance. But I do not want to read candlesticks all day. I do not want to jump into day trading. Not saying that I wouldn't be good at it. Maybe not. Maybe I am. But I do not have the passion for it. And a large majority of people, the numbers show, lose. It's better to dollar cost average and just pick good stocks, good ETFs, good mutual funds, and do not try to be a day trader, because the numbers show that also not only do the day traders lose, but retail investors, regular people like you and me, we win overwhelmingly majority of the time. Time in the market is more important than timing the market. So do not do that. If this video is giving you value so far, guys, please give a like. Please subscribe. New videos every Monday and Thursday on personal finance and how to improve and build wealth. And also, because this video is about investing, I have an investing ebook in the description down below, and that will help you on your journey into picking good growth stock ETFs. And also, if you want to get an email from me every single Friday, newsletter, link in the description down below. The third mistake that beginners tend to make when they're investing is they invest money that they will need soon. Do not do this. Investing is not an emergency fund, and it is not a savings account. Investing is investing. You need a savings account, an emergency fund, and an investment account. Do not use money to invest that you want to use in a short time frame. As I said, time in the market is better than timing the market. And so if you're trying to pull money out because, oh, I need a new car, oh, I need a house down payment, let me invest 10 grand and see if I can flip it to make my house down payment. Do not do that. You are going to lose if you're trying to do that. It's not going to work out for you. If you know you need that money, you should save it, and you should not invest it. Just save it, pay for whatever you need to pay for in cash. Don't think you're going to put the money in the market for 2-3 months, double or triple it, and then take it back out to buy the thing that you wanted to buy. That is a mistake. Not only are you going to pay a lot of taxes on that because you're withdrawing too early, but the market might be down when you come to withdraw your $10,000, and it could be $2,000 in there. Whereas if you let that thing sit for 5, 10, 15 plus years, you're most likely going to be withdrawing more than $10,000. So do not invest money that you need in a short time frame. I see a lot of newbie investors do this. They think they can flip $10,000 in 6 months. That is not the way to go. The fourth mistake I see newbie investors making is not diversifying. Everybody investing knows you need to diversify, but I'll see people go all in on crypto and lose their shirt, lose their life savings, lose their kids' college fund. We have seen it over the last 18 months with the fall of Bitcoin and other crypto coins. You cannot do this. You shouldn't even go all in on stocks that are good, that you think are good, like the Teslas and the Amazons or the Walmarts. You have to diversify. My personal preference is to always invest in growth stock ETFs, and that's just a group of stocks that tracks a particular segment of the economy. So you have broad diversification, and that's what's in my investing ebook. It's 20 ETFs that covers hundreds and hundreds of companies across different industries. That is true diversification. And if you want to play it safe, do the S&P 500. I don't think personally it's as diversified as it used to be, because a lot of the top companies in America are tech companies. So if you are investing in a fund that tracks the 500 most best companies in America and 400 of those companies are tech companies, then your S&P 500 is going to have a tech heavy leaning towards it. Now, that is not completely on the money. I'm not saying there's 400 tech companies in the S&P 500. I'm just saying that the S&P 500 is heavily weighted by tech companies. Don't be surprised if it's not as diversified as it was 10, 15, 20 years ago. But with that being said, you have to diversify as a newbie investor. You have to diversify. That mitigates your risk across different industries, and it will make you more money long term, because if one sector of the economy is down, another sector might be up. So you could still be winning even when a part of your portfolio is losing. The final mistake I see a lot of newbie investors make is not having clear investing goals. If you fail to plan, you plan to fail. You have to have an investing plan. You cannot just jump into investing and not know what you want to do, how long you want to do it for, how much money you want to put in the investment account, how often, and so on and so forth. For me personally, I dollar cost average. That means you put in the same money every single month, whether the investments are going up or down. That's dollar cost averaging. You could do it on a monthly basis, yearly basis. I say monthly because it's much more better to get investments when they are fluctuating, because when the market is down, you're getting it cheaper. It's not that you're losing money. Those are not realized losses. So it's still a good thing when the market is down, as long as you are dollar cost averaging. But you have to have a goal. Do you want to have a 10-year plan for your investment portfolio, a 20-year plan? How much do you want to withdraw if it's going to be your retirement? You have to have a plan. Do you want to have a dividend heavy portfolio where you just get checks every single month or quarter coming into your bank account passively without even having to worry about that? I see a lot of people, they get on the internet, they get so excited about investing, they open up their Robinhood or other brokerage account and they just put $100 in there and then they just forget about it 2 weeks later. You have to have a plan, you have to have a strategy in order to protect yourself, but also to make sure you are staying on top of your wealth building journey. And that's it for the end of the video, guys. I appreciate you guys for watching. If you've reached this far, subscribe, appreciate it, become part of the family. Give this video a like. New videos every Monday and Thursday. I will see you guys. Have a great day. Peace.